Investing is not easy and your portfolio is struggling to keep up with the game. And today I want to give you the secret sauce on how to build that growth portfolio that everybody's been talking about, how they gain and beat the market. Peter Lynch, the legendary investor who gained 30% year on year, has always taught me that the real key in making money in stocks is not to get scared out of them. Take the risk. Then Warren Buffett added on to my teachings that diversification is protection against ignorance. It makes little sense to know if you know what you are doing. That's why it's important to diversify.
Have you ever wondered how I could do my stocks? I could do my YouTube videos and keep a day job and be a dad and everything. I use an app called Notion. I've chosen many different note writing apps, but Notion has been my go-to for the last few years. Especially last year and this year, the Notion is dictated from my web page making and my organizing of my folders and also my daily task making at work. So Notion, it's free to use. I do my paid version so I can do a lot of sharing of web pages. As you can see, I've built my own note sharing from brainstorming devices to as much as my social media manager, and even for my dashboard for tasks that I need to do on a weekly basis. And Notion is truly, it's my day-to-day go-to.
This guidance is for anyone. Anyone's got a job like me, day job, and you want to manage your portfolio, your family's portfolio easily, and it's passive investing. What makes it better? It's smart and passive investing. It's a systematic approach to invest your portfolio, the mindset that you need to tune, the plan and the rigorous go through. And today I want to show you that secret sauce on how to beat the market. In fact, how to beat that index so that you can get better ahead of the game. The problem with internet these days is everybody shares what they buy, what they own, how they won at the end of the year, how much yield they gain, but they never really shared the systematic approach. And today I hope to break that norm and show to everyone that it's possible as a father, as a mother, to manage your son, your parents' portfolio, or your own retirement portfolio and get ahead of the game. And that way, if you beat the index, then you don't have to just invest on the boring index and go with the gain the expensive hedge fund managers do, but at your own cost, that you don't have to pay high fees. And the secret of success is to build a pyramid growth diversification. Yes, a pyramid. Remember the Egyptians back 3,000 years ago built this enormous sculpture, and they built it from ground up and then all the way to the peak, and these structures have lasted up there for 3,000 years and still immaculate. And that's how your portfolio should be behaving to be long lasting in all volatility. The pyramid method of growth diversification comes in 4 parts. And firstly, the most important part, the big base. The base stands for cash. You need to have cash, regular injection of cash, regular savings. You have to work hard, save. If you don't have cash, you're not going to go anywhere. You have to get the cash. And once you get cash, like I always tell people, the first $10,000 USD should go to index or staple, or good growth stabilized dividend stocks that you can see there. And for example, as of today, as of 2024, the likes of Apple, Microsoft, Costco, McDonald's, S&P 500, NASDAQ, those are strong, stable index. And cash, obviously, that you have to hold to build this strong foundation, because regardless of what happened with the economy, these companies are here to stay. They're here to serve the people, because end of the day, we all still eat McDonald's, yeah? The next level up is the mature growth. 25% allocation to mature growth stocks. These are companies that's already established. They could be the mega cap stocks that's established in there. The stuff that we use day to day. Companies that you, your children, and your grandchildren will be using for the foreseeable future. And examples of mature growth could be from the likes of Netflix, Facebook, and Lockheed Martin defensive shares, or you could go into Louis Vuitton, Ferrari, luxury stocks, or the Nike. These are the stocks that show mature growth because they'll be here to stay. Your great children will be using them. They're just slower on the growth, but they're stable and they're significant to the growth of any economy in the world. And now let's get a bit more adventurous, and this is where people struggle to grow in their portfolio, is to own some high growth stocks. 25% high growth stocks allocation. These are the stocks that's still growing, still strong, great fundamentals, turn around like the likes of Airbnb, the Uber, the AMD, the Nvidia, all the stocks that you hear every day that's making change to the world, that are disrupting the economy, the Amazons. These are the guys that's disrupting everyday life, making our life even better. That's why high growth needs to be included. Not more than 25% because you want them to grow eventually. So don't go over because you over your risk. But this is the area for growth that people missed out. And finally, my last one, also the secret weapon that people don't take enough risk, is to go high risk. Like Peter Lynch always say, if you don't take enough risk, you're not going to grow. But you have to limit yourself to 10% of your overall portfolio. If you take high risk stock, penny stocks, whatever stocks that you think of, if the 10% goes to zero, worst case scenario, you only lose 10%. But potentially the upside for this penny or this super growth stocks, they could potentially escalate 2, 3, 4 times. We're talking about the Pinterest, we're talking about the Shopify, we're talking about the Coinbase, Robinhood, anything that you can think of that's new, fresh, energetic, they can go into the market and make that difference. Again, not more than 10%. You only take that amount of risk. If they start growing, you trim it, or if they start growing, they might go into high growth stocks. They might upgrade themselves. This is how we keep our mindset to keep it, the boat, the pyramid, stabilized. And 2 more things I would like to add in is, if anything goes wrong that you need to sell, you always sell from the top to bottom. Okay, if anything that's on a discount that you've got money you need to buy, you always buy it from the bottom to the top. For example, if Apple's on discount and then you got some penny stock that's on discount as well, you're not going to jump in and buy that penny stock first. You go buy the Apple first, because it's very rare for this Apple and Microsoft to get discounted first. So that mindset is also very important in the growth. So it keeps you in the game. It keeps you priorities at bay. So once you build this portfolio, your base, your stable, your home for your investment, you have to review. You don't review every day. Don't look at your phone every day. You only review quarterly or half yearly, when they release data, when they release evidence of the profit and growth, and then you can think whether you want to buy more or you want to take profit. So that's important. Don't look at your phone every day. And what that's done, that's you. Your growth portfolio is there for you. So I hope you enjoy this episode of how to grow your stocks portfolio. That's how people work at it, but the systematic way is what I have taught you today, and I hope you've taken it home. And if you want, you can go to my link below on my website to download this PDF, stick it on your wall, make it as a PDF mark that you can do, or even share with your kids on how to generate the mindset in place. Thank you very much. Please subscribe to my channel, and also hope to see you in more future free videos like this.